Today, we are going to talk about the tax computation for the corporate tax purpose and how do we do an adjustments in that computation and what kind of arm's length benchmarking would be required for the connected and related parties transaction. Just to brief about myself, I'm Manish Saraf. I'm a chartered accountant with over 21 years of experience into audit and tax field. Prior worked with Deloitte, PwC, and in UAE for last 8 years, helping clients on the tax advisory, on the corporate tax, on the VAT side. With me is Prakriti Dangi. So Prakriti, you may just introduce yourself.
Hi, Manish. Thank you. Hi, everyone. I'm Prakriti Dangi. I am a chartered accountant and having 12 years of experience in transfer pricing. I work with SNB and here to discuss more about the transfer pricing as per the UAE corporate tax.
Great. Just to add on to Prakriti's experience, he brings in international and transfer pricing experience in the different geographical regions. Her expertise lies on the benchmarking, transaction analysis with the connected parties, related parties, and the documentation, which is critical in the UAE region for application of the transfer pricing. And as SNB, aside beyond consulting, we are primarily working on the consulting based in Dubai and Abu Dhabi. Primarily, we focus on the corporate tax, VAT, transfer pricing documentation, advising clients on the technology consulting, process policies documentation, and other deals acquisition. So let's start with today. So what I'm going to present is based on the different federal decree law and different ministerial decisions being issued time to time. And what we present is not should be considered as it is, because you would definitely require to consult prior to taking any decision. So our is just a personal opinion based on different decisions issued by the authorities, and we have analyzed and presented based on the whatever has been identified, and it would be our personal opinion. So don't take as it is. You need to consult in your business scenarios. So great. So today we're going to talk about the corporate tax applicability. I'll take 1 or 2 minutes just to give a background and then get into the tax computation, what are allowed, disallowed expenditure, and what kind of tax loss reliefs we get, and the unrealized adjustment which are required. And Prakriti will talk about the documentation for the connected party, defining those connected party relationship, and then what are those transactions which are there within the group company or connected parties that require arm's length benchmarking, and what are those documentation required for. So with just a background in terms of implementation, as we all know that it implemented from 1st June 2023, and it would depend upon the financial period of each of those companies. And most of the company in UAE have the financial period of Jan to December. So it's get effectively applicable from 1st January 2024 to 31st December 2024. And that is the first tax period. And then in corporate tax, there is a one annual return to be filed, which is filed after 9 months of the end of the financial period, which would be like if Jan to December is the cycle, then it would be 30th September 2025. Whereas in VAT, we see that it is quarterly return being filed. Now that is for the juridical person. Now for a natural person, if they are for a natural person, the tax period is always Jan to December by default. Be whatever period they've started. If someone has started as a consulting, is a freelancing business, has started in the month of August 2024. So his tax period is always Jan to December by default. And for a juridical person to see where the financial period is mentioned, it is generally in the memorandum of association. They can look at the financial period mentioned on that. So as we see, the corporate tax rate is either 0% or 9% generally. And for general case where we see it is not opting for a qualifying free zone or qualifying activities benefit, then the slab is up to 375,000. It's a 0% tax. It's a tax on the profit of the company, not on the turnover. So net profit. So suppose the company has a net profit of 500,000, it's 500,000. So the tax up to 0% is 375,000 is 0%. Beyond that, that is 125,000 is the 9% tax being paid on that amount. Now, qualifying free zone need to meet up different criteria to be eligible to get those activities. First, they need to see whether they fall into those qualifying activities or not. So for the qualifying, it would require a detailed discussion, but just to overview that for the qualifying income, which meets those criteria, they will get a benefit of 0%. And for the non-qualifying income, it is straight away 9%. So there they don't get a benefit of 375,000, 0%. So straight away, whatever income is earned on the non-qualifying, if it's 500,000 is a non-qualifying income, they pay 9% straight away on the 500,000. So there is no slab of 375,000 for them. So that we will, that will be taken up a separate topic. So just to mention it that, I mean, as I'm going through these topics and presentation, you can make a note of your questions, whatever you have. So you can put in the chat box. We will discuss those questions at the end of the session. So on each of those topics or points which you are raising up, whatever questions come to your mind, drop down on the chat box, and we will take up those questions at the end of the session. So in terms of taxable person, we know that it is resident person or non-resident person. So resident person could be a juridical person, which is like LLC company, or an individual as a natural person. So from the perspective of resident person, it could be incorporated, registered in UAE, so a company registered in Sharjah or Dubai mainland, and it could be in free zone. So free zone could be in any, it can be Dubai Silicon Oasis or Zabza free zone could be there. So that has a separate applicability in terms of based on the activities they carry out. So they would be taxed in UAE. Now it's a company which is incorporated outside UAE. So like I have a company in Singapore, okay, and that is being controlled and managed from UAE. The control and manage means the key decision maker or the owner, the shareholders are based in UAE, taking decision for the company in Singapore. So even that company is considered to be a resident in UAE. The concept is place of effective management. So the place of effective management is in UAE. So that is a resident in UAE. So the income earned in Singapore get taxed in UAE as well. But then there is a concept of tax credits. So whatever tax is being paid in Singapore, that get a credit back in UAE. So you don't pay a double tax on the same income. Then there's a concept of natural person. So natural person who conducts any kind of business activities, like if I'm doing a consulting activities as an individual person, then that is a commercial activity and that get taxed. But there are certain activities a natural person is not taxed. There are three activities, like, which is like a salary or bonus, which I get from the company is not taxable. If I'm doing a personal investment in any security market shares, that is not taxable. And also on the real estate, if I'm holding any units in the real estate, earning rent income out of it, if I sell these units, then the gain or loss which is there, which when I'm selling that property, I don't get taxed, or a rental income which I earn as an individual don't get taxed in UAE. Now, from the non-resident perspective, either it could have a permanent establishment in UAE. So permanent establishment means like if a company based in Singapore has a branch in UAE, so through the branch, it is operating in UAE. So that becomes a permanent establishment. And whatever income is earned by that permanent establishment, so maybe there could be an electronic trading company who has a main office in Singapore and trades in UAE through a branch on that electronic item. So the income earned is getting taxed. Now, deriving a UAE source income, that means any kind of income being earned, whether they may have a branch, they might not have a branch, but they have an agent who works for them, earns income from selling those in UAE, then that would also get taxed. That's a non-resident person income become a taxable. Now, having a nexus in the UAE, that means if now for the nexus, they have defined specifically that if a non-resident person is holding a property in UAE, earns a rental income from that, so that rental income is getting taxed. Now the concept is here, it's only for a juridical person. It is treated non-resident person, it will be treated in similar way that whatever the benefit is given to a natural person, a non-resident natural person also gives the same benefit. So if a non-resident individual from India is holding a unit in UAE and is earning income out of it, that's because a real estate income. So being a non-resident from India is holding a unit, it will not be taxed. But if it's a company, if a juridical company based in India is holding a unit in UAE and earning rent, or if we dispose of that property, makes a capital gain, that is also get taxed. So a juridical person, non-resident person on the properties get taxed in UAE. So now coming to the main topic of the tax liability computation, how that tax liability, there was a recent guidelines being issued by the FTA, and we have taken those points from there. So if we see, first we will have an accounting profit. So accounting profit, which is computed based on the accounting standard, the IFRS. I know there is a net profit, and based on that, there are certain adjustments to be done, because something which would have added or deducted from the initially in computation of accounting profit, that might not be eligible in the computation of tax liability. So those adjustments need to be done. So some of those adjustments required are unrealized gain and losses. So we will talk about each of them in detail. Unrealized gain and losses is something where you have not actually made a gain. You have not physically sold it off, but it's just a book net gain or losses being booked because of the revaluation of the properties, because of the fair value change in that asset. That we will talk about it. And there are certain exempted income, because those incomes are not taxable. So that will not be added back. So that income which you have already included in the profit will be adjusted. And then a relief is basically in terms of within the group company, you are transferring the assets. There are certain adjustments need to be done, and the major is the non-deductible expenditure. There are certain expenditures, which would not be eligible to be deducted for the computation of tax liability. So you would have already deducted in computing your net profit, but here when those expenditures are not eligible, then you need to add back those expenditures. That is what we will talk about it. And adjustment with respect to the related parties transactions, that is specifically which Prakriti will cover about, that what kind of adjustment need to be done. And then the tax loss reliefs are the one which the company is having losses, and how they can set off those losses in future period or within the group company. That is something. And then you derive your taxable income, and from the taxable income you compute the tax payable, which is, I mentioned, like if a company is having 500,000, 500,000 of taxable income, up to which up to 375,000 is at 0%, and above that is 9%. So accordingly we'll compute the tax liability. Then you have adjustment with respect to the withholding tax and tax credit. So where you have outside investments and you are paying tax there, so the whatever tax is paid outside UAE, that get a credit in here. So your net payable is accordingly computed. So let's get into the detail of each of them. The first important point is with respect to the accounting profit. Now the accounting profit has to be calculated, computed. Either it could be based on the cash basis accounting, but cash basis accounting is only applicable for the companies or the which are earning, the businesses which are earning revenue less than 3 million, does not exceed 3 million, and also they only can opt for cash basis accounting. Now what is cash basis accounting is where you have actually collected the money. So if a consulting firm have a revenue of consulting services of 2 million in 2024, but actual collection he would have made is suppose 1.75 million. So 250,000 is not collected. So whatever is collected is for that portion, they would, so 1.75 will be considered as their taxable, as the revenue for the purpose of computing the tax liability. Now with respect to the companies which are having turnover up to 50 million or above, so from 3 million, so 3 million above and up to 550 million, they can opt for IFRS for SME, small medium enterprise. So those they can apply for, applying the IFRS for SMEs, or if they're having more than 50 million, then they need to follow the full-fledged IFRS reporting standard. Now in case of the tax group, so when there is a tax group being formed, for them they need to prepare a financial statement. So A, B, C are like same group company. So A, B, C company, A company, B company, C company, they all three need to prepare their individual financial statement, and then consolidate those financial statement and exclude those intercompany transactions to derive the tax liability in case they're opting for a tax group. And as I mentioned, with respect to, for companies which are having a turnover of more than 50 million, they need to mandatorily get their financials audited. For the computation of a tax liability, their financials need to be audited first, which having a turnover more than 50 million, and then they would need to compute the tax liability. Now, Similar for qualifying free zone, because if there is a company which is opting for qualifying free zone, so irrespective of the turnover, whether they make a turnover of 3 million, 10 million, they need to get it audited because they are getting a benefit of 0%. So the authorities would like to see the financials, whether the criteria where they are actually applied for to be eligible for qualifying, whether they are meeting those, and that can be only known they review the financial and it is getting audited. So that is important. And if in all, whether you follow cash basis or your IFRS standards, the revenue has to be reported in arm's length standard. You need to report that based on the market arm's length pricing basis, which again Pragati will talk about it. That is the key criteria for any kind of accounting standard being followed. Revenue has to be as per the arm's length standard. Now getting into what are deductible and non-deductible expenditure for the adjustment to be done from the accounting profit. The first and foremost important is that it has to be for the pertaining to your financial period from which the tax period is starting. So your first tax period is Jan 24 to December 24. So any expenditure being incurred in the year 2024, those are the only expenditure which get deductible. Now suppose you have a liability pertaining to any vendors into December 2023 financials. Suppose the liability was around 10,000 in the books and you paid that liability in the month of April 2024. Since that expenditure pertained to the 2023, it will not be deductible in this because you would have already accounted that liability in your 2023 books. So in 2024, you won't account because that is not pertaining to 2024 financials. And the other important aspect is it should be incurred wholly and exclusively for the business. Now, that is important here. It comes into picture where a company would have given certain benefits of like a car facility or telephone facility. Now, those are which could be used. Some of calls could be used for personal purpose, and some of the even like for travels and a car. It will not be 100% used for business purpose. It could be also used for your personal travel as well. So in that case, when it is not wholly and exclusively, so then these are proportionate amount. This need to be identified proportionately. So in that scenario, the proportionate amount, maybe a company would have a contract that assuming that 60 or 70% of a tenfold bills assumed to be will be a company purpose and 30% could be a personal. And similarly goes for that in your car facility which is given to an individual. So that contract has to be documented where there is a mix of personal and official use. And something which is not wholly exclusively for the business could be you're making a personal travel and claiming that from the business, and that specifically for the shareholders, that the owner driven businesses where they would have their personal expenditures and claiming it from the business, that will not be allowed. Now something with respect to the capital in nature, that means if you are buying an asset, that will not be deductible because the capital expenditures are depreciated over the period of time. So on depreciation is allowed as expenditure in calculating your taxable profit. So if you're buying a car for the company and the car value is whatever the value would be, it would be like 100,000 is the value of the car. So those value which is been there, it will not be depreciated, it will not be charged in the year 2024. So the depreciation will be only charged to the P&L and not relating to the exempt income because you have not included that income. I mean, you have not considered your income for the taxability. So any expenditure pertaining to that will not be. Suppose dividend is an exempt income from any resident company in UAE. So if you would have invested on that particular company, so if you have borrowed it from the bank to invest in that particular company, so the interest paid on borrowing it to invest in another company, that interest component will not be deductible because the dividend income which you're earning from that investment is an exempt income. So expenditure pertaining to that will not be deductible expenditure. And any other specific expenditures which, time to time the authorities come out with that. So these are some of the examples, salary and bonus pay to the directors. Is it a wholly and exclusively for the business? Yes, it is wholly and exclusively for the business but then there need to be an arm's length benchmarking to be done because payment to any connected party or related parties, a shareholder being a related party, connected party to the business. So whatever payment is being done to them need to be in arm's length. And that specific documentation has to be covered, which we will cover in later topic. That is getting a deductible. Then any employees benefit, inspector company C reimburse the cost of setup of office at home, because now we have a remote work setup. If a company is allowing an employee to work from home, and an expenditure of office setup in terms of desk or whatever electricity portion is being paid for that particular employee, that is for the business as he's working from home. And taxes, like the local taxes, municipal tax is an expenditure, but if a corporate tax is there, will that be eligible for deduction of expenditure? Corporate tax is not eligible for deduction, because corporate tax is a tax which you are paying in your income. You will not deduct that as an expenditure, but any other expenditures pertaining to the authorities which you are making payment, that become deductible. But fines are something which you pay. If you pay fines to the authority for late filing of your VAT return, that is something which is imposed because of your non-compliance with the regulation. You are paying those fines. Those fines are not eligible to be deducted. Now, expenditure incurred for entertainment of shareholder and his family. Now, this is in personal nature. So this is basically for his private purpose, and he has went with his family. The amount which is paid for him is not allowed as a deductible because it is personal expenditure. But yes, if a shareholder himself is going for business trips and is making some personal visits, doing some other activities, then 50% is entertainment expenditure allowed for individual. But when he's going as a leisure trip with his family, it is incompletely allowed, disallowed. Then, like employees travel expenditure. So an employee is traveling, and because it may be that someone is traveling to Riyadh, to Saudi, and he's spending weekend there, so he might incur some expenditure for his personal movement around and having food around that place. Then like 70,000 is total expenditure being incurred by the employee during his travel to Riyadh, Saudi, and then 20,000 out of that was spent on his weekend. Now, since this is something which is for his business purpose, and company is entertaining, and I know because he's an employee to motivate, and company is encouraging, it's a cost for the business plus for individual. So it's like an incentive being given to spend on the weekend. So that is an expenditure, complete 100% being allowed for the employee. But if it is a shareholder, it won't be allowed. It would be 50% allowed to the owners, or the partners of the company. Now, pre-incorporation trade expenditure. So company which has incorporated in 1st August 2024, and prior to incorporation, they would have incurred some consulting fees to identify the place and other expenditure, and any other expenditure being incurred prior to the 1st August. So that would be still allowed because that's something which is pertaining to the business. So any expenditure being incurred for the business purpose, it may be from prior to the incorporation date, then that would be still allowed as a deductible expenditure in the first tax period of that particular company. Now, in terms of capital expenditure, as I mentioned, the capital expenditure are not like if a company is buying an asset like car, it will not be deducted as 100% expenditure, but depreciation. Now, there could be certain cases where where the small values of asset being purchased, though they may have a useful life of more than 1 year, but they are small in value. Maybe like, for example, here is given about a hospital which is buying a medical equipment, and the value of the medical equipment could be 100,000 dirham, or it could be 700, but the life of that particular equipment is more than a year. But those are in small quantity, but the volume is high. So as per the accounting policies, what they have defined, they may expense it off, they may not capitalize it, though that asset seems to be a capital nature because the useful life is more than 1 year, but still they can expense it off as per the accounting standards. Similarly, we can have printers which value is smaller, or scanners the company is buying in and they are in large volume being purchased. The value is small, those can still be an expensed off, but it should be in their accounting policy. Now, similarly goes for a license of a software. I mean, for software subscription, we have a license. We pay annual payment for that. Since we are paying an annual fees of subscription, like Zoho accounting software, if you are paying it annually, that's an expenditure. It's not a capital value item. So it's a revenue expenditure. You can deduct it 100% in your business. Now, something which could be non-deductible in the case of capital expenditure, like a company C is paying a fine of 50,000 for non-compliance to environment regulation. Since the amount is big, the company thought of capitalizing it and charging it in the business income over a period of time. maybe like 5 years, 10,000 each year they would charge it. But since it is a fine, this expenditure would not be allowed for computation of a tax liability because it is a fine. So even that they would have capitalized that 50,000 and 10,000 is being charged. So that portion of depreciation will not be allowed as a expenditure in your computation of accounting or your tax liability. So that need to be added back. So this will be an adjustment in your financials. So these are summary of some of those non-deductible expenditures. First is pertaining to donations. Now, if you are making a donations, but it will be only eligible when those donations are being done in a qualifying public benefit entities. So those authorities have, FDA has released those qualifying public benefit entities, which are like a non-commercial organization, and where you're making a donation, those are only eligible. But if those where you made a donation and that is not part of that list of those qualifying public benefit entities, then donations will not be allowed. If you're making a contribution to any political parties or anywhere, if it is not included in that list, then it won't be allowed. Now, another is input value added tax claimed in ITC. Now, suppose because input value added is being claimed from your output. So, say suppose you have a telephone bill of 100 and 5% is the VAT on that. Since that portion of VAT 5% can be claimed from your output, you will not be claiming 105 as a deduction, but you will only claim 100 as a deduction. 5 is already claimed from your output. But suppose if you are not claiming that, recovering that 5 dirham from your output, and you have an expense of 105, then you cannot go and claim that 5 dirham as an deduction from your tax liability, because you are eligible to claim that from your output, but you have not claimed it. So you will lose that benefit. So you need to keep a track of whatever is eligible as a input credit from your output, claim it from the output. Otherwise, you won't be eligible. But there could be some certain expenditure, like for employees, expenditure has been incurred, employee meals, which are not claimable. A VAT being paid on that portion, it is not claimable from your output. Then those portions which are not eligible to be claimed from your output, you can go and claim it, from your tax liability. So to derive a tax liability, you can deduct that portion. And any kind of bribes and illicit payment that is not allowed. And entertainment expenditure, we will talk about it, that 50% of entertainment expenditure pertaining to your partner, shareholders, that is limited. But for employees, it is 100% allowed. And then with respect to the interest on related party loans, so if the owner is given a working capital funding to the company, and then whatever funding they are giving in, first they need to be interest. First, we need to see whether there is a substance. Substance means it is actually for the business purpose. It is not for the purpose of funding the company to withdraw its profit or to withdraw its share capital, but it is actually used for the business. So if there is a substance, means if it's being used for the commercial business purpose, the loan which the owner has given to the company, then he would be eligible. That interest portion which is being paid by the company to the owner, that is eligible to be deductible. But there need to be a arm's length benchmarking, which will cover about that what rate that should be considered. Now there could be other penalties and fines, as I mentioned, is not deductible. Then again, with respect to your net interest beyond, the interest amount which is being paid to the bank on the funding and all, there is a limitation. It is limited up to 30% of EBITDA earning before interest, tax, depreciation, and amortization, or up to 12 million. We will talk about in detail about it. And then any tax on the income, like corporate tax which you pay, or any foreign income tax which you are paying, are not deductible as an expenditure, because corporate tax, as I mentioned, is not expenditure. You are paying on the net profit of the company. And foreign tax also, you get a credit in your you will be getting a credit on your tax liability. So that is not an expenditure. So entertainment expenditure is pertaining to 50% only for, if that is being incurred for your customers, shareholders, suppliers, or business partners. It will be limited to 50%, and it can be with respect to any meals, accommodation, or transportation. And if it is for the employees, it is 100% allowed. So here's an example, and if employee staff and treatment such as staff parties or offsite events, companies generally organize an annual event or take them out for any kind of activities, team gathering, team bonding activities, then it is 100% allowed. Now, if that, suppose a company is giving a gift to any person on his wedding, like an iPhone is being gifted to to a family member of the employees or to the employee himself as well. Since it is being gifted during his private occasion, that's not a deductible expenditure. It's only when you are doing it for the team of employees, in the business forum or anywhere. So that is deductible. But for any personal individual gifting or anything which is being done, no, it is not a allowed expenditure. And as I mentioned, for shareholders, customers, partners, those are 50% deductible. So if company has incurred, suppose 50,000 on gathering of customers, organizing an event for the customers, shareholders, out of 50,000, 25,000 would be eligible and 25,000 will not be eligible for deduction. And then with respect to the interest, it's I mentioned that it is either 12 million or 30% of EBITDA, whichever is higher is eligible to be deducted expenditures. So suppose if a company is having 50 million of the EBITDA, earning before interest, tax, and depreciation, so up to 30% is basically their 15 million is something which even if it is more than 12 billion, but 30, whichever is higher, so 30%, 15 million is higher, they can still claim that. And under the definition of interest, it covers all kind of fund. It's not only the bank funding interest which you are paying it, but it's also performance guarantee, a personal guarantee which you pay. That is also the eligible to be part of the interest component, or even your leasing, financing leasing which we do. It's the interest component on that finance lease is also being covered in the included in this interest limitation rule. And this 12 million rule is basically is for the period. It will be proportionate, like if your first tax period and in your first tax period you have a business, you have commenced your business on suppose 1st June 2024, and this period is for 7 months, so the 12 million will be proportionate to 7-month period. It will not be like for 12 million you eligible for 7-month period, so it will be proportionate to that period. Now, the other critical provision is with respect to the provisions or bad debts. Now, if you have a provisions, we generally create a provisions for receivable or customer warranties claims you would have created. So if a trading company has a receivable, until the end of 2023 December, suppose there is a receivable provision which is created for 60,000. Now, if you are getting money back, in 2024, or you are reversing that provision, maybe out of 60,000, if you are reversing maybe 30,000, where in this case I mentioned like 25,000 was a provision and you're reversing it into 2024, then that amount get taxed in 2024. Why? Because in 2023 income you would have already deducted that provision. So now in 2024, when you're getting that money, it get taxed in 2024. So you need to see in your financial that how much provisions you already carried until the end of December 2023, and you might get recover that in the next year in the taxable period, then it get taxed. So you need to plan it accordingly. And similarly for bad debts, if you would have written off any kind of customer receivables prior to first tax period, maybe you have written off, maybe again I'm saying the same example, like out of 40,000 bad debts which you had in 2022, 25,000 is recovered in 2024. So though it pertained to 2022 bad debts, but you recovered in 2024, which is the first tax period, assuming Jan to December is a cycle, then that 25,000 get taxed in 2024. So any recovery happening in the tax period, it will be taxable. So looking at some of the exempt income which are to be excluded and or adjusted in computation of a tax liability, which you would have included in accounting profit, is dividend, which I mentioned that if you made an investment in the company and receiving a dividend in the UAE, it's a UAE based company because this is only received from a juridical person that is a resident company. So maybe as an individual I would have invested, I get a dividend from there, and that will not be taxable. Or even a company A is invested in company B in Dubai, company A based in Sharjah invested in company B in Dubai, so and they get a dividend from company B, so that dividend income is not taxable because dividend is already taxed when it is after the profit. So the profit which is taxed from there after you declare a dividend, so it is already taxed in the profit, so you won't again charge a tax on that. Then dividend distribution received from a participating interest. Now, what is a participating interest in a foreign juridical person? So if I have invested in a company in Singapore and if I'm getting a dividend from there, that amount will not be taxable, but provided certain conditions are being met as a participating interest. So if I'm holding at least 5% of the capital of that particular company in Singapore, and that Singapore company is also paying tax, because I mean, if they're not paying tax, then I don't get a benefit, because if they are that amount is already taxed in the Singapore, and they also have a similar tax, corporate tax there in the Singapore, then if whatever in dividend I earn from them will not be taxable. Even it could be by a company A would have invested in company S in Singapore, so dividend earned by the company A in UAE from Singapore will not be. But the criteria is that they need to hold 5% of 4 million, whichever is lower. So 4 million, 5% of 4 million, whichever is the lower portion. If they're holding it, then they get a benefit, and that's need to be holded for 12-month period. And similarly, any impairment gain and loss or capital gain and loss, forex gain and loss from that particular investments they are making in, it will not be taxable. The other is, if you are deriving any income from operating an aircraft, ship, or international transport, that is any companies, shipping business line or aircraft operation, it is doing a worldwide transportation, so that is not taxable derived by income by a non-resident person, because and they need to be reciprocal rule is basically the other country also need to be like, if a Singapore airline is deriving an income from operating between Singapore and UAE, then they will not be taxed, and even the international shipping line also, they will not be taxed, provided both of them follow the same standard. Like, we are not taxing, the UAE is not taxing the Singapore, and Singapore is also not taxing the UAE. That's a reciprocal rule. An income of a foreign permanent establishment, like, if I have a foreign permanent establishment, if I have a branch in Singapore, the branch is a foreign permanent establishment for UAE company, and then they can opt, this is an optional to them, whether they want to tax their branch income of Singapore in UAE or not, provided that the Singapore also has a similar tax rate of corporate tax being paid there, so they can opt that the foreign branch will not be taxable. So any expenditure being incurred for that particular branch from UAE, that will also not be deductible expenditure, because we are not taxing that income from there. The other key concept is with respect to the unrealized gain and losses. So unrealized gain and losses is where you have not actually sold that asset, and you would have made a gain, but it's just a book gain. So you don't earn actually physical, there's no cash realization or even you're not receive that. And which company where it is applicable. So if you see, unrealized gain and losses could be applicable for the businesses which are preparing their financials using accrual method of accounting system. That means they are realizing and they are accruing for those income or expenditure. It's not on cash basis. So cash basis is, you would only account anyway like when you have actually collected it. So there is no concept of unrealized or realized. It's only on realized basis, only in cash accounting. But if you're following an accounting accrual basis concept, where you could accrue for that income, you might not have received that, or there's an expenditure you might not have actually paid for that, but you have accrued that. So those cases is there where you would have a unrealized gain and losses adjustments required, and it's applicable to all the asset and liabilities which has a fair value or impairment accounting. Now, or all the capital items. So fair value generally would be used for your land. Suppose if you have a land and you would value at per the market, do a fair value treatment of identify that value of that land, and then you might not sell it off at the end of the year, but you just assess the value. So any gain when you make it will not be taxable. You will reverse that amount if it is already included in your accounting profit. And the election whether to go for unrealized gain and losses, whether to make an adjustment for unrealized gain, it has to be made in the first tax period. So the first tax period, someone who has the financial period, tax period of Jan to December. So when they are filing their return, there will be an option: are you opting for unrealized gain and losses? That if that is ticked in first tax period, then subsequent tax period also you will follow the same method of computing your tax liability, because consistency as per the accounting standard, general standard is that consistency has to be followed. So you follow the same, because then it could be compared from the previous period of tax liability what you have done. So here are a few examples, like during the year end December 2024, company C recognized a revaluation gain of 10 million on a land So the cost was 50 million, and at the end of December 2024, they have again the value has changed to 60 million. So the 10 million which would have been included in your profit, accounting profit, you need to reduce it from your for computation of a tax liability, because that is the land is not sold actually. So you have not yet realized it. It's only a book transaction. And similarly, a company which has other financial asset which is being measured at the fair value. So the original cost may be 250,000 and the value has gone down by the end of the year is 200,000. So the loss of 50,000 will be added back because you would have reduced that from your accounting profit. So you need to add back that because that is not a realized. So you will add back after the count for computation of a tax liability. Then similarly, a company which has holding an inventory, there is a loss of inventory value of 100,000 maybe. So the value would have been 1 million during the year, but by the end of the year, the value has gone down to 900,000. So there is an unrealized loss of 100,000, which you would have deducted in your accounting profit. But for computation tax liability, you will add back because that is not a realized. You have not sold that inventory. Now, the concept with respect to the tax loss reliefs, so which you have losses, how you can adjust your losses from your company or from other company which meets the certain criteria of qualifying group or tax group. So the tax loss relief is deducted against the current tax period and a subsequent tax period, and this has to be pertaining for the tax period. Now, when the first tax period is 2024, and if you have a loss of suppose 50,000 in 2024, that loss can be adjusted against your subsequent tax period, and there is no time period defined to carry forward the loss. But suppose if you had a loss in 2023 or 22, at the beginning of 1st January 2024, you had a carry forward loss, business loss of 50,000. Now, since that business loss as on 1st January 2024 pertain to your 23 or 2022 carry forward, you cannot adjust in 2024 income because 2022 and 23 your corporate tax was not applicable. It has become applicable from January 2024 for your financial period. So you will not be able to adjust that loss of 50,000. It's only from the period when you have started applying the corporate tax provisions and the corporate tax is applicable for you. From that period only you can be eligible to. And also like 75%, the losses can be only considered can be carried forward or set up to 75% of a taxable income. So we will look an example for it. So suppose you have 100,000 net profit in 2025. So 75% of that is 750,000. So 75,000 is out of 100,000. 75,000 is the maximum amount you can adjust your loss of previous period. And then other for eligibility to be a tax loss relief is that you need to hold at least 50%. There need to be 50% common shareholding to be continued. So 2024 there were 3 partners, and then 2025 there is a change in the shareholding. Though they are still the 3 partners, but one partner changed, another partner came in. So those existing partners should continue to hold 50%. Another is that if there is a change in the ownership less than 50% as well, but that business which was there should continue, because the reason is that the loss was pertaining to that particular business. So that business should be in existence to claim your prior period, previous year's losses in the future period. So the same business should continue. So if there was an electronic trading company which was there in 2024 and 25, there's a change in the shareholding and you had a loss in 2024, but the shareholder has changed, but the business still continued. So the loss which was there in 2024, you can set off in 2025. So this is an example, where I'm talking about is that if you had a loss of in 2024, the first tax period, you had a loss of 275,000. And then, that this 275,000 can be carried forward to 2025, but up to 75%. So 100,000 was the income. 75% of it can be claimed. So the balance remaining in 2025 is 200,000, which can be carried forward for the future period. Now, the main point is that you cannot opt that, okay, because my income is less than 375,000 in 2025, then why should I set off my loss of 2024 and carry forward to the future period? It's not that. First, you have to set off your loss. You cannot just, because you are not anyway paying the tax, you will not be, you might not just, you would try to not to take a set off of loss because you're not going to pay tax. irrespective, whether your tax liability is there or not, you still have to take a setup of your losses of prior period from the current period. So if it is less than 375,000 is a profit, you still have to take a claim from that amount. And these losses can be carried forward for indefinite period. Then with respect to the qualifying category, where company A is there and company B is there, they can set off losses if they form a 75% common ownership between A and B is there, and it could be direct or indirect. And this 75% could be only claimed when between company A and B when they are in the same tax rate. So if there is a qualifying free zone company A and there is a company in mainland B, they cannot form a qualifying group because they are at different tax rate. So they cannot be getting that carry forward or setup of losses. And the same financial period, Jan to December, and the accounting standards would be the same. And similarly, up to 75% only it can be claimed. So this is an example company A and company B. The revenue of company A is 2 million and it has a loss of suppose 550,000 is the loss. So, and assuming that they form a qualifying group having a common shareholding of 75% and they are in the same tax rate. So company B had a loss. So company B is making a profit of 600,000. So out of 600,000, only 75% of it can be set off of company A losses. So 75% is say 450,000 of 600,000. So up to 450,000 of company A loss can be set off. The balance 100,000 will be carried forward. So company A balance 100,000 will be carried forward for the future period, and it can be again set off from the company B in 2025. Now the tax credit is basically after you have completed your tax law adjustments which you have done, and then the reliefs, tax reliefs which you have loss relief you have claimed. So now what are the tax credit after you are arriving your tax liability? So the tax credit is with respect to the foreign tax credit. Now, if a company A, which I mentioned that I am invested in company B in Singapore. So whatever tax I would have paid if if I have not claimed an exemption criteria, so whatever tax I have paid in that, I can claim it from the my UAE company. So because I have to include the income of company B in Singapore, in company A in UAE. So I would have first included that income, and the tax which I have paid in Singapore will be taken as a credit in the UAE. And the important point is that I cannot carry forward that. I can only limit to whatever tax corporate tax is due in UAE. Suppose if I have a tax liability in UAE of 20,000, and I have a tax which I have paid in foreign tax in Singapore is suppose 25,000. So my recovery or my tax credit is limited to the tax which is liability is due in UAE. So 20,000 is a due. The 5,000 which is in addition, I cannot go and claim because authority will only allow to what they, the company in UAE would be liable for. So they are not going to give a refund which they don't earn. The company in UAE is not making money. It's in Singapore. So here's an example for this. So there's a revenue of 2 million, deductible expenditure 1.2, the loss of 800,000. Now, so there is a tax payable of 38,250. Then there's a foreign tax credit, which is there in your 10,000 is a foreign tax credit from the Singapore, so you eligible. So this 800,000 is not a loss, is actually an income on which you are actually paying 38,250 as a tax liability, and then out of this you have this 10,000 as a foreign tax being paid. You take a credit of it and you pay the net tax payable is this. But in this revenue you would have already included your Singapore income, then only you take a credit of in UAE. Then another concept is withholding tax. So withholding tax is generally applicable for non-resident, a non-resident who doesn't have a permanent establishment in UAE. So he doesn't have a branch or he doesn't have any kind of office setup in UAE, but it is dealing through an agent or is directly supplying. So he's directly supplying. So if there's a consulting company A in UAE providing consultancy in Oman, and they are directly being serviced from UAE to company in Oman. So they would have deducted, there's a withholding tax in Oman, and they would have deducted whatever the tax rate would be in Oman, they would deduct the withholding tax on that. So that the tax which is being paid is a withholding tax. Similarly, it applies for non-resident. Now, non-resident, which is based in Singapore, is a Singapore-based company, which is doing a consulting service in UAE, doesn't have any office set up in UAE. So when they would do the service, the withholding tax will be deducted in UAE, and the net amount will be paid. So currently, withholding tax is 0%. So there is no tax credit as of now. But when that rate changes in the future, so whatever tax which would have been charged on the withholding, like suppose it is 0% current, there is no setup for this. But if suppose the rate changes to 5% in the future year, and the company in Singapore which have which from which the deduction of 5% was made, and tomorrow that non-resident set up a permanent establishment, then it become a company which is resident in UAE, then it would pay a tax. So whatever tax which would have been deducted as withholding will be set off against its net tax liability. So it's only when company changes this structure from being a non-resident to a resident, and then they earn income, and whatever tax was withholded, tax was deducted, that gets set off as a tax credit. But currently withholding tax is 0%. So now moving on to next is with respect to the transfer pricing, connected party, and arm's length, which I will hand over Prakriti to take over from here. So Prakriti, I will switch off my sharing, and now you can share your screen.
Sure. So Manish, please confirm if my screen is visible.
Not yet.
Just tell me if it is now. Is it?
No. You have to share your screen. I mean, you can see the cursor below.
Yep.
Yeah.
Yeah.
Great. So you can do in the, yeah. Perfect.
Sure. All right. So thank you so much, Manish, for this comprehensive overview on the UAE corporate tax. And
Prakriti, just before that, I think you need to share your screen on the presentation mode.
Yeah.
Is it
now?
Yeah, this is better because I think your notes were appearing in.
Okay.
Now
All
it's
right.
good. Okay.
Okay. So yeah, thank you for providing insight on the corporate tax of the UAE and the deductibility of expenses and others. And from where you have mentioned about the topic of arm's length standard, while on the deductibility of expenses and on the eligibility for qualified free zone persons, I will take forward from here. And we'll discuss upon first the transfer pricing on the aspect, why and how it was introduced. So we have an example that there's a company A which is producing product A. Now it has selling to company B as well as C. B is a third party and C is a related party. Now what happens that while it sells to B, it's selling for 20 dirham, and while it's selling to C, which is a related, it's selling for 10 dirhams. So the concept of arm's length price says that when the transaction is with a related party, it has to be done at a price which is as if it is a transaction done or undertaken in an independent scenario. So, and why is this required is because company as a whole, the group as a whole might not have any difference in the difference in the profitability as a company group as a whole. However, it might result into reduced tax liability for the group as a whole, which they are paying in the respective jurisdictions. So the concept of transfer pricing has arisen to determine the arm's length of transaction with for transactions with the related parties. Now, the corporate law has, in Article 34, has mentioned 5 methods for determining the arm's length price. And each of the methods have different level of things to say that what is the manner and mechanism for determining arm's length. For example, comparable and controlled price method talks about comparison of the price of two transactions, whereas resale price method talks about distribution of goods and determining of comparability. Cost plus method talks about charging an arm's length profit markup on the total operating cost of provision of services. And transactional net margin method talks about the net margin analysis and comparability with companies in similar industries. And in case all the five methods, if none of the substantiation of arm's length is not done by any of these five methods, then one can certainly refer to any other method with proper documentation that how these five methods were not able to substantiate the arm's length determination. Going forward, it's important to understand the definition of related party for moving ahead. So Article 35 of Corporate Tax Law of UAE provides three aspects to determine the related party relationship, which is kinship, ownership, and control. So by kinship, we mean common blood ties as determined by ancestors or common ancestors of individual. And it also covers relationship with affiliate and guardianship. The ownership talks about shareholding in a juridical person, direct or indirect, alone or along with the related parties. The concept of control is talks about the influence of a person over the other by way of voting rights or composition of board of directors or sharing of profits and significant influence. And let's delve into each of the aspects. So while we talk about kinship, which is the first parameter of determining whether related parties exist or not, the kinship is a relationship with the ancestors of a natural person to the fourth degree of kinship. So if I am a person, my fourth generation below and fourth generation above will be covered. It also covered relationship by affiliation and by guardianship, as well as any relationship arising as by result of adoption. So we will take a few case studies here. So there are two persons, Mr. A and Mr. B. There is a transaction of payment of technical fees. The scenario first is that Mr. A is brother of Mr. B. So whether there will be a related party relationship between Mr. A and Mr. B? So the answer to the first scenario is, of course, yes, because brother is covered under the one of the fourth degree of kinship. The next case scenario is where Mr. A is a nephew of Mr. B. Again, it is covered and both the Mr. A and Mr. B would be related party. Mr. A is a grandson of Mr. B. This relationship is also covered. The important point is even the adoption and relationship occurring out of that is covered. And hence, if Mr. A and Mr. B are related by means of that Mr. A is an adopted son of Mr. B, this relationship shall be considered as a related party. And last is Mr. A, if it is guardian of Mr. B, this is again covered. So we have holistically covered all four degrees of kinship to understand the applicability of related party for individuals. The next concept is of ownership. It is a relationship between natural person and a juridical person. And it requires ownership of shares wherein the shareholding is more than or equal to 50%. It can be, the ownership can be done alone by that individual or along with the related party that we have seen before. Again, a direct and indirect, both sort of relationship are covered here. The both type of shareholding are covered here. So Mr. A is a shareholder in company A and holds more than 50% of shareholder. Clearly, it is a related party. In the second scenario, Mr. A and Mr. B are related parties and they together hold more than 50% in company A becomes related party. It might so happen that each individually do not hold more than 50% of shares, but together if they hold, they constitute a related party by means of ownership. So here we have some case studies. Mr. A and Mr. B are related parties. They both have investment in company A. The scenario first says that Mr. A is a brother of Mr. B, and they together own 55% shares of company A. So, and we are looking at whether Mr. A and Mr. B are related parties to company A. In this case, because they together hold more than 50%, yes, they are related parties. In the second scenario, they are brothers. They are related parties in terms of kinship, and they together hold 45% shares, which is less than 50% as required by the law. So sorry, this is not a related party relationship. Mr. A is a friend and adopted brother of Mr. B, and they together hold 55% share. First definition is of adopted. So in this case, since A and B are adopted brothers, so the point trigger of kinship, which includes adoption, is covered here. And when they together hold 55%, they both are related parties to company A. The last we are talking about, Mr. A is a nephew of Mr. B, and A holds 25% and B holds 15% shares in company A. The first criteria of kinship is triggered, and the second criteria that they together should hold more than 50% is not met, because they are holding only 40% shares in company A. So here they are not related parties. Going ahead with relationship between two juridical persons. So it is again divided into three aspects. A juridical person alone or together with related party directly or indirectly holds 50% or more ownership interest in the other juridical person. So it's same like we spoke about earlier. There was a natural person, two natural person, and relationship between them and shareholding in subsequent shareholding in the juridical person. Here we're talking about a juridical person alone or along with a related party and holding share for more than 50% in another juridical person. The second criteria talks about a juridical person where he alone or together with related party controls the other juridical person. So now we are not talking about the shareholding or ownership, but talking about the control, which we will discuss in detail later in the slide deck. The third criteria is about a person alone or together with related party directly indirectly holds 50% or more of ownership interest or in controls towards such more juridical person. So this is a situation where a person might not hold or have control directly, but again in indirect way, and a common control if arises, it again triggers the related party relationship under this clause. Again, we have some case studies. So there is a company A which holds 100% shares in company B, and company B holds 90% shares in company C. So in this case, company A is related party to company B. The answer to the question is yes, because A is holding 100%, which is again more than 50%, which is required in the law. And the second scenario is whether company A is related party to company C. So for this, we have to do a simple calculation to check the indirect shareholding, which is 100% of 90% is again 90%. So here, of course, they are related parties to company C. The company A is related party to company C by indirect control. Now, if this 90% changes to 30%, let's see whether company A continues to be a related party to company C or not. The calculation again is done and the criteria is not met, which is 30% only. So now these company A and C would not be related party as the shareholding is less than 50%. Moving ahead, there are other clauses which talks about related party relationship arising as a result of a person and its permanent establishment or a foreign permanent establishment. For example, a person has an office or a branch in a foreign jurisdiction. It is termed as a foreign permanent establishment. Those are also covered in the related party relationship. The second example is partners of an unincorporated partnership. So a very classic example of this could be two persons gathering together and forming buying a real estate property and exploiting it and receiving income from that. So they don't form a company, but they are doing it on their individual basis. Here, they are forming a unincorporated partnership, and the partners in this setup are related parties to each other. The last is about trust or foundation, where the trustees, beneficiaries, the founders, the other members of the trust become related parties to each other. So we spoke about how the control beyond the ownership also triggers the related party relationship. There is a definition of control, but still it is very vast in the scope. So first aspect of control talks about having ability to exercise more than 50% or equal to 50% voting rights in another person. So there's company A and company B, and company A has ability to exercise 50% or more of voting rights in company B. Then both the entities become, the control is triggered and they become the related party. This is irrespective of the fact that they have ownership interest in each other, which is irrespective that it is less than or 50% or there is none ownership interest. The second criteria is talks about exercising of determination of composition of board of directors. So it talks about that if a person has ability to determine the composition of 50% or more of the board of directors of another person, both of these persons become related party by means of control. Again, if a person is able to receive 50% or more of profits of another person, it becomes a related party. And the last criteria talks about the importance of significant influence. Any juridical person, if able to exercise significant influence over the conduct of business of another person, becomes a related party in terms of control. The definition of significant influence is not, this term is not defined in the law, but it has to be seen by the conduct and the transaction that they are having. So these are a few examples of explaining how the control mechanism works and turns into a related party relationship. So for example, company A is an investor in company B and holds 49% of shares. So the shareholding criteria or the ownership criteria is not met here because the ownership is less than 50%. But if company A is having the responsibility to manage the day-to-day operations of the company, they're able to formulate key business strategies of company B. They're able to perform key market decisions, enter, negotiate, and conclude the contracts, and so on and so forth. Then in this case, A is having a control over the functions of company B, and hence they are related parties. In the next scenario, we see that company A is company B is providing technology to company A, say for example, for manufacturing of products. And in return, it is paying a royalty to company B. Now, in this case, if company B has an entitlement to more than 50% of profits of company A, then company A and B becomes related party due to control. The third example talks about control where company A has received loans and pays interest on such loans. If this loan constitutes, say, more than 50% of the total capital of company A, then again it is triggered. The control mechanism is triggered and they become related party to each other. All right. Moving ahead next is the connected persons. So connected person, the definition is important from the perspective of UAE corporate law because there is no tax on individuals here. And that's why the companies the juridical person or the companies may transfer their profits as a payment to connected persons. And that's why an arm's length determination on the payment to connected person is very important from the UAE law. So how to define a connected person is, or the payment is, any payment or benefit provided to connected person shall be deductible. So we earlier, Manish, spoke about the deductibility criteria. So here we come again and say that any payment or benefit that is transferred to the connected person will be deductible only when the payment or benefit is corresponding to the market value, which is the arm's length value, and it's wholly or completely exclusively incurred for the purpose of taxable person's business. When we talk about connected person here, the first example would be an individual who has a direct or indirect ownership interest or control in the taxable person. The ownership percentage is not defined, but we take the leverage from the ownership defined in clause Article 35. And we say that if an individual is having an ownership interest with the company and receiving any payment, it becomes a related party relationship. And the other example is payment to a director or officer in the taxable person. So this is very open, and again, there is no fixed definition of who will be constituting director or officer, but it's important to understand whether that person, what is the roles, the responsibilities of that person are in the company, whether they are exercising any control, whether they are able to make decisions and likewise. And that way, based on a comprehensive analysis, it becomes a connected person. And the third criteria is relative of owner or director or officer. So while we spoke about director officer, their relatives to the fourth degree of kinship again triggers the related party relationship in connected persons. And while we spoke earlier that the partners and unincorporated partnership and the related parties are again covered here. There are few exceptions. While they are not required, the company is not required to determine the arm's length of payment to connected persons, which is a taxable person, which is whose shares are traded on a recognized stock exchange, or person who has subject to regulatory oversight of a competent authority, or any other decision issued by the cabinet. Otherwise, all companies in UAE are required to determine an arm's length for the payment which is made to the connected persons. The payment to connected person does not necessarily mean the salary, but it also includes other benefits. For example, salary, perquisite, rent, interest on loans, etc. And it's important that we, so independently undertaking a benchmarking of payment to connected persons might not be possible because every company has its own vision and mission and policies. Every company is operating at its own level, and a comparison would not be holistically done. But any analysis on a net profit basis would be very helpful to understand whether the payment to connected persons are at arm's length or not. And again, it's important that whenever you are making drastic changes to these payments, you should keep a proper documentation on record so that if FTA comes and scrutinize these changes, you have substance to show the same. Going ahead with the related party transactions. So now we have understood what is a related party relationship. Now we are talking about what are the types of transactions that are covered, which may call for arm's length determination and benchmarking. So it's every transaction between party is a related party transaction. And examples could be purchase, sale of goods, provision or receipt of services, any financing arrangements, or payment of royalty in terms of intangible property, so on and so forth. And today we would be discussing upon the services, the intra-group services as a related party transaction. If we have to define intra-group services, these are the services which are centralized services in a multinational enterprise. It happens that not every enterprise would be providing the individual services. However, they take benefit of the group synergy, reduce cost, increasing the efficiency, and focus on the business to earn. And that's why they provide the provision of services is concentrated to one or more entities, and the benefit are received by more than one entities, all the entities of the group. UAE corporate tax talks about transactions on which the related party transactions which are cross-border control transactions as well as domestic control transactions. And for each of these transactions, domestically or cross-border, an arm's length principle is important to be determined for the control transactions. Going ahead, any company which is providing management services or maybe technical services or know-how for operation of plant, or providing any marketing support services for catering to the bringing in the sales, or providing any support services in the nature of procurement or sourcing support, are the basic varieties of intra-group services. And again, as discussed, it covers both domestic transactions as well as international transactions with the UAE entity. Again, there are certain services which are categorized as low value added support services, and we will discuss upon them as well in later. So while intergroup services are very common services that are generally provided between the multinational group or within the local UAE based group, it is important to identify the cost for the services as well as to determine the arm's length which is a profit markup for these. So there are two methods which are prescribed to determine the costs. If one entity, say ABC LLC UAE, is providing IT support services to various entities across the globe, now the question arises that what is the mechanism by which it should charge each of these group entities? Now, if the costs are directly, the benefits which are being provided to multinational group entities are directly identifiable in terms of maybe number of software licenses used by the beneficiaries, or number of service tickets raised by them, or maybe the hours spent by the IT team for providing services to each of the entities. If, or maybe any other mechanism is available on record, then it is called a direct charge mechanism. And the only issue with this is it is sometimes difficult to identify the direct charge, but it is always preferred and always easy to justify or substantiate before the tax authority if the direct charge mechanism is adopted. The other method for cost allocation is the cost allocation method, which is also called as indirect charge method. In this, a total cost pool is identified, and any duplicative or shareholding costs are there. Those are reduced. So the net cost pool of provision of services to the beneficiaries is then allocated to the entities which have utilized the services. Taking the example that ABC LLC UAE is providing certain back office support services to the various group entities across the globe. And now, if it has to charge back the benefit of the services that it has provided, and it is not able to identify any direct mechanism for the chargeback, it can rely on any allocation mechanism. It is important to identify and document a proper allocation key, which could be based upon the revenue or the headcount or expenditure, and likewise. And that's how the total cost can be allocated to each of the group entities. It's important that the services provided, the indirect charge method should be adopted only when the value of services provided cannot be quantified with respect to each recipient entity. And again, a separate recording where involves administrative burden on the multinational enterprise. So that's why an allocation mechanism can be used. It becomes very important to document the whole process of arriving at the allocation mechanism, and again charge an arm's length markup utilizing the benchmarking analysis on them. So the documentation required for intra-group services would constitute collating information, which is what are the nature of services that is provided. A description of it should be kept handy. Then, what is the rationale for providing the services to the group entities? What are the list of beneficiaries who are enjoying the benefit of these services? And the beneficiaries should also keep a record of what are the benefits that they have received from these services. And it should not be just a charge from the HQ, but actual services should be received and should also be compared with the third part. If these services had been received from a third party, which is independent, so the nature of services received should also be coincidental, that instead of receiving the services from a third party, this has been received from the related party. Then, as we spoke earlier about the allocation key, how the allocation keys arrive, what is the rationale for it, and also the calculation by which the allocation keys arrived at. And of course, use a benchmark to identify a profit markup on the cost of services that are provided. One should also keep a written record of the contract, which should cover the agreements with the beneficiaries, which should also cover what is the nature and description of the services and the terms of contract and the conditions under which these services are provided. And this written contract should also have a calculation covered with it, which clearly talks about how the cost pool is formed by identifying the cost center, and any cost which is duplicative or directly identifiable, or maybe for the benefit of the shareholder or the HQ, should be reduced while arriving at the total cost. Then an allocation key should be applied. For example, company A is providing intra-group services to 5 entities in various other jurisdictions. Then if they are using revenue as an allocation key, that allocation key should be calculated and documented, and the cost of service providing is, for example, 100, and the ratio is, say, 20, 20, 20 each. And this is just an example. The expenses should be allocated in the same ratio, and it should be consistent over the years until there is a substantial change either in the services provided or the beneficiaries. So a documentation is very important in terms of preparing so that it can be provided to the UAE FTA upon the request. Any adjustment. So while we earlier spoke about the deductibility of expenses, we understand that any expenses which is not deductible any expenses will not be deductible if it is not at the market value or does not meets the arm's length principle. Any difference between the actual expenses and the any value arrived using the arm's length principle, the difference of this is to be adjusted while calculating the corporate tax liability or taxable income for computing the tax liability. If you do not provide this analysis or you say that the payment done meets the arm's length principle, the second stage would be when your tax return is scrutinized by the FTA. And in that case, if any adjustment is made by the FTA, in that case, that will be again adjusted with the total profits. It will be added, the difference will be added to the total profits, and the corresponding adjustment will be again given to the related party. So if company A has made certain, the FTA has made certain adjustment on account of arm's length pricing of the taxable income of company A, and it has entered into certain transactions with company B, so the corresponding impact of this will go in company B's taxable income computation as well. Now, I would ask Manish to take over from here.
Yeah. Thank you, Prakati, for taking us through the definitions of connected related parties and the control that's important. That ownership is not only the ownership, but the control also has a relationship on the connected and related parties. And Prakati, you can continue sharing that screen. I mean, because CT administration, I'll quickly run through yours, what you were sharing in. And also the last point which Prakati was mentioning about the intra-group services, so that adjustment which I was mentioning in computation of your tax liability, that you need to do adjustment with respect to your arm's length transactions, those which are not in arm's length. Suppose the services which are being provided by company A to company B, it's like there's a the company is into consulting services and as well as digital marketing. So company A is into consulting, it's the same group. Company B is into digital marketing. Now the digital marketing services is being provided to across external customers, and as well as the digital marketing is done for company A for their consulting service as well. So now if something that is being charged in the market, they would charge, suppose, as a cost, they would be charging like 50,000 is the cost for the digital marketing services to the external party. And then now internally they may charge high because maybe consulting services is having higher profit and the tax amount is high. So maybe company B would charge it at 60,000 the same services to company A. So the difference of 10,000, once we do that arm's length benchmarking, the documentation which Pragati was mentioning, then they arrive at that. The FTA, when they do the audit, they'll say that 10,000 is extra charge which is being done to company A to reduce their profit, and company A might not be making much profit. And so from that perspective, it's okay to earn more revenue in company B books, but company A was making more profit, and to reduce that profit, they would have charged high. So therein where the arm's length benchmarking documentation come into play, and those documentation has to be there. Now, with respect to the CT administration, what generally is required. Can you move to the next slide? So, it's basically with respect to return filing, the documentation, the registration. So the first thing is the registration. As we know that the registration is applicable to all the business houses. There is no threshold as such, for the registration requirement applicable. So every company, whether they make a profit or not, they have their business, they need to register. But for natural person, there is a threshold of 1 million. Like if a natural person is having a revenue, because there would be someone who's doing a small consulting services, a small activities, and where the value is not exceeding beyond 1 million. So government authority has mentioned that for them registration might not be compulsory. But for any juridical person who's making a business, maybe his revenue would be 1 million or less than 1 million, or more, but and he's not going to pay any tax liability. He's not will have a taxable income, or he will not have a net profit in this year. But still they need to register, and the registration deadline is based on the year, on the month in which the tax and that trade license has been issued. So, and generally it is 3 months or 2 to 3 months after the trade, on the month in which the trade license is issued. So you need to see those, what is the deadline for your company registration if you have not yet done that, because there is a penalty of 10,000 that need to be care of. And also with respect to the return, as I mentioned, that it is one annual return to be done, and it has to be filed 9 months after the completion of the period. Whereas in VAT, we have seen that there was a quarterly return, but in the corporate tax, it is a one annual return after the 9 months period. So the next talk about in terms of what are the key points which you need to look at. As now the purpose of the session was to just give you an insight about what kind of adjustments you might have to cover and how that has to be done. And because now you are approaching towards the end of the year, and then those adjustments how to has to be done, what need to be taken care of, what documentation need to have in. So as part of first is understanding the structure, the shareholding structure, what are there, what is, do you have a business outside UAE, does it fall into the POEM aspect, place of effective management, will it get taxed in UAE? And in terms of individual holding or company or shareholder structure, group company structure, what you have, and if you have activities which falls into qualifying activity, are you meeting those substance requirement? Are you get eligible to be free zone? That need to be assessed, that whether you're going to be benefiting from qualifying free zone benefit of 0%. That we need to do that. And we also assess our clients, where they might be having a qualifying activity, like distribution is a qualifying activity. Today they might be doing it from the mainland, but they might be eligible to be benefiting on those. So we assess those qualifying activities and help them to documentation or the substance requirement. And then those related parties, which Pragati was mentioning about, that we need to identify the documentation for them, and those adjustments which need to be done, in terms of the exempted income, the deductible, non-deductible expenditure, and to see whether you have a permanent establishment or a UA source income which could got taxed, and the kind of contract and arrangement which you need to have in place for this, and also help on the training perspective. We help our clients on this, and we do a mock tax assessment of financial year 2023 to see what is your tax liability arriving in based on the current status, and what kind of changes to be built up in your financials, so that what will be the potential difference or impact saving comes in when you make those changes in your financials, and you benefit of the whatever the provisions which are there. You apply those provisions and you take those adjustments in your financials. So we do a high level assessment of to look at the study or financials, analyze that, do the structuring, and then do a tax computation, and then also help in the transfer pricing benchmarking. We have a good team working upon the transfer pricing related party transactions, the documentation for that, and we have those database which is OECD prescribed, and support on the implementation, those changes which has to be put in place in your financials or an accounting system to be in compliance with the corporate tax requirement. Yeah. So I think, yeah, that basically what we have talked about it today. So, and we are happy to take up the questions. And I see, I think, couple of questions being here in the chat box, and you can still drop down your questions, whatever comes up in your mind. So the first question which I see from Mr. Kasif, that for an interest on related party loan, how do we define substance? I mean, so the shareholder, the owner who have funded the company, and now the substance is when it is for the business purpose, it is for the commercial purpose. That means if a company, if a owner has funded a working capital fund of suppose 200,000, and that 200,000 funding which is being given to the company is being used for the commercial purpose, for running operations of the company, or buying asset of the company, or paying of the liabilities of the company. So that is not for the personal gain of the substance is proved, because it is for the commercial purpose. But now if as a owner is funding the company 200,000, and it is for the withdrawal of benchmarking, I think Pragati, you will take it up. Hope you will cover benchmarking. Okay, so yeah, I mean, anything which we have covered about it, anything aspect you want to specifically ask about it, so we are open to answer it. So Pragati, anything specifically you want to highlight, with respect to the benchmarking, or which definitely which any organization need to be careful about? I think one of the aspect which Pragati would have covered is with respect to the connected parties, the payment, the share to the owners. If because as a connected party, as a owner, they would be playing, and most of the companies which are closely held company here, which are run by individuals, so they would be contributing to the business as a CEO, like I mean, they are contributing to the business as a owner, being an owner. They're not hiring any external CEO, but they're acting as a CEO and being part of day-to-day operations of the company. So until now, since the corporate tax was not there, they were not drawing any kind of salary, they're just taking the profit from the company. But now when they have to charge the salary to the company to I mean, because they are contributing to the business, so beside the profit they want to charge to the company for the salary. So how that would be done, how that assessment will be carried out, that how what amount they should be charging in the company, and how that will be the documented, what kind of documentation would be required for that, Prakati? If you can try to, I think, enlighten our
So, yeah,
participants.
sure. So yeah, it is difficult to say that if a company has a CEO or a CFO, it is difficult to compare the salary of CEO with salary of CEO of another company. The philosophy of growing of any company is different, and you cannot match these on a salary to salary basis. But and here comes the importance that while you have to determine arm's length of these payments for the deductibility of expenses purposes, you need to also put into place what are the roles and responsibilities of the persons who are the connected persons under the definition in corporate law. Again, whether you have any contractual arrangement with them, what are the responsibilities that they are performing in the company, what are their roles in terms of the agreement, negotiating with the customers or concluding the contracts, and likewise. And again, as I mentioned, that uh, a one-to-one comparison with the salary is probably not the best idea, and it would be better to undertake a benchmarking on a net profit level of the entity. So if a company A is making payment to connected persons, the profitability of the net profitability of that company should be assessed before the payment to the connected persons and after the payment to the connected persons. And this profit percentage should be compared or benchmarked with similar companies in same industry operating at a same level of revenue or the same range of revenue and other financial aspects. And that's how you can bring out a comparability, a broad comparability that can be used to substantiate that any payments or benefits paid to the connect persons are at arm's length.
Yeah.
Sure. The other
Yes.
aspects in benchmarking, if I can take this over, is
Yeah.
various methods which are provided in the law for undertaking the benchmarking. So as I was discussing earlier, there is a method called comparable uncontrolled price method, which talks about price to price comparison. Let's take an example. If you are a dealer in say bullion, and you have to make a comparison for any related party transaction of buy or sale of this bullion, what you can do is, if there is an index, or if there is a third party transaction with transaction with a third party, you can compare price of each of these transactions. However, this method is very stringent and requires similarity to a great extent. This is how the CUP, or the comparable uncontrolled price method, works. There are other methods which are less stringent and more about the function, talks about the similarity in the product or services. For example, there is resale price method, which talks about that in case a company is engaged into distribution of goods, then in that case, whatever value addition that the entity is bringing by reselling these goods. So the company would be buying certain goods in a trading entity format, buying certain goods and selling to the related party or third party. So in that case, it's important to see what is the value addition done by this trader, and this can be assessed in terms of a profit percentage which they are receiving. So ideally, in resale price method, we use a gross profit by sales analysis and compare with the similar companies in the same industry. And there are other methods which are like transactional net margin method, which again compares the net operating profitability. And for resale price method, transactional net margin method, there we use databases which are which provide a holistic list of companies, and they also provide the financial parameters based, and we select those parameters. So for example, we can select the threshold for revenue, or we can select a percentage of R&D percentage by sales, or similar other financial ratios can be kept. For example, intangible to total assets ratio. It depending upon the functioning and the analysis of the company for which the analysis is performed.
Yes,
And
I think Prakrit, just to add on to this, I think this functional risk analysis plays a very
yes,
critical role
yes,
to do any kind of benchmarking. So functional analysis with respect to what are the actually nature of the transaction and the volume, the business which they are into. So those parameters need to be documented first before we get into the benchmarking, then, because that is the base input which will be the criteria to be used for the benchmarking purpose.
Absolutely. So while benchmarking is the economic analysis, which is talks about the comparability and comparing the profits or the margins, the functional analysis is the base, which talks about analysis of the FAR, function, assets, and risks of the entities which are transacting, the related parties which are entering into the transactions. So in detail, in-depth analysis and interviews with the functional teams of the company to understand the transaction, to understand what each of the related party in the transaction is doing, what is the risk capability, what risk that they are actually assuming, what are the underlying assets basis which these services or any transaction is being performed. So a holistic functional interview is required to be carried out to come up with a FAR analysis that again becomes the base for the economic analysis, and hence benchmarking and comparability happens.
Sure, great. Thank you, Prakati, again, for giving us a detailed understanding about it. So I see one more question being put up by Gerlach
Yeah.
is saying that is the it's for me to take up for this. I think this is the impairment loss on receivables related to participating interest. Will it be a non-deductible expenditure? Yes, it will be, because when it falls under the definition of participating interest, there are certain criteria to be met on those investment which are participating interest, and those income is exempt income. So when you are exempting that income, which is participating interest income, is an exempted income. So any kind of the losses which you have, the expenses or the losses, you cannot deduct it. So it's a non-deductible expenditure. Then I see there's one more question before that Pratik has asked is how we set up the incentive structure for I think it was pertaining, I think you were mentioning about shareholders or owners. And his question was pertaining to how do we set up an incentive structure for shareholder and owner. Just to add, and maybe Pratik, you can further add this to this, is that incentive structure, I mean, as it's basically it has to be any payment which has to be done to a owner or shareholder, it has to be in arm's length. So the incentive structure will be as per the company standard policy, like whatever the basis they take up, the target or whatever the structure. Like there could be a general manager in the company, a general manager who's operating a business of automobile, and then there is a local owner of this company, and this local owner has given complete decision making authority to the general manager of the automobile, and he is making his decision in terms of the way he want to operate the business, and the key decision making of that particular company is done by the general manager. So he becomes a connected party, and his interest is involved in that, because his stake or his profit, his salary or his bonus at the end of the year will be dependent upon how the company is performing. So he becomes a key management person operating that business. So the incentive structure for him could be as a standard practice, as a standard practice in the market, in terms of it could be based on like whatever the profit this company is making it, that particular business line is making it, that certain percentage of that he might have an incentive. So that company management will decide, the owner will decide, but whatever he gets, that need to be benchmarked. So his salary plus the other incentives or perquisites which he draws, that totality figure which Prakati was mentioning on the particular slide, whatever he gets will be taken into consideration for the benchmarking documentation perspective. It's not only the fixed salary, but any kind of perquisites or incentives which he draws will be taken up. And incentive structure will be as per the company practice, a policy the management decides to put up in place. So hope that's well taken care of. Or Pragat, if you want to add anything on this.
Absolutely. It's not just the direct payment made to the connected person or the owner or the shareholder, but that at the same time, any other benefit that is derived by them. And the value of that has also to be derived. Maybe it is in kind or any other mode, but that has to be taken care of uh, by a proper analysis and documentation. Again.
Yeah, great. So I think, yeah, I mean, we covered the topics, and we addressed whatever the question put in. So Prakati, just can you put the last slide? I think we have so transfer. Okay, there's one more question by Pratik. Transfer pricing. Yeah. So
Yeah.
transfer pricing documentation are advisable for the payment to the connected persons, or it's a requirement mandatory by law. It is not an advisable, it is not an optional. I think it would be mandatory. So Prakati, you can just talk about it. Is it a mandatory to
Sure.
document? for the payment to connected parties?
See, for determination of arm's length, a documentation which is prepared on a contemporaneous basis is always required. We spoke about deductibility of any expense. It can be done only in case it is the transaction with the related party is at arm's length. So of course, so there are two aspects to it. A transfer pricing documentation is required to be prepared when there are certain threshold which has been crossed by a juridical person. However, arm's length has to be met irrespective of whether that the documentation, which is the local file or the master file, is required to be prepared or not. And while we say that arm's length has to be substantiated, there has to be some documentation on record that you can give to the FTA to say that yes, arm's length has been met. So it might not be the whole master file, the requirement as per the master file and the local file, but something should be kept on record on a regular basis. For example, if the financial year is financial year 24, this documentation prepared on a contemporaneous basis, which means prepared when the transaction is done during that year. And so that FTA may ask or raise a scrutiny maybe 3 years or 4 years down the line as may be required. But if you have prepared this arm's length substantiation right now when the transaction has been entered into, you are safe in terms of be any scrutiny comes, you are safe and you have something to say before the FTA. So documentation is different, ALP determination is different, but ALP cannot go alone and it certainly requires some documentation on record. I hope that answers the question.
Yeah, I think so. And to sum up that, it is, yes, it is mandatory by law because maybe what happened in the VAT when it was introduced in 2018 and onwards, they were not much question, but when the authority started auditing those, they were looking all the documentation. So if in similar, the corporate tax perspective, if we start documenting in the year one itself, that it's easier, to substantiate when the authorities ask for those documentation or audit requirement. Great. So I think we are done with our all questions whatever put up, but we are open to address any questions later on. Also, we have our details. So Prakriti was mentioning, go to the last slide. I think we would have our contact details, and we can be reachable. We can be reachable on this number. Email us. If anything you want to ask or any queries you have further, we will help to support you on that. So that these are details, and you can reach out. We have our office in Dubai and Abu Dhabi, and also we have associate in Saudi as well. So we support our clients having presence in the Middle East region, whether be in Saudi or other region as well.
Yeah.
Great. So yeah, so that's it for today, and thank you for patiently listening us. And so we will share this deck. We will share this deck email to you all. If you can share, whoever has already registered and they have shared the email ID, we will share to them. And else who have not yet shared that, you can drop down your email ID and we will email our presentation which we discussed today. And we are open to discuss later on. You can connect us through email or phone numbers.
Thank you so much. Thanks for being a great audience. Thank you.